get started. So my name is Rob Beardsley. I'm the founder of Lone Star Capital. This is a quarterly webinar that we put on, which is our deal flow analysis. It's really our most popular webinar, and it's really a great tool for not just our investors and people in the community to gain insights through our deal flow about the broader market and the trends and strategies, but it's also a great way for us internally to learn more about it. It forces us to be organized, keep track of our deal flow, and get nuances from it as well. So it's really helpful. It's not just a marketing piece. We don't just put this on. It really is valuable for us as well. So with that being said, Charles, you want to quickly introduce yourself and share your screen, and then kind of give a rundown of what the trade tracker looks like and the basics?
Yeah, so Charles Waldron, I do the acquisitions here at Lone Star Capital. I've been in the firm now for almost 3 years, and so, that comprises like maintaining relationships with the brokers, making sure that we're, getting the good deal flow in, and then just, valuing, selecting opportunities that we're going to pursue and kind of managing all of that process, and kind of getting our opinion in place. So, focused a lot on Houston here, as well as a little bit on Dallas. And so we try to really make sure that we understand the specific market. And yeah, so with that, I guess I'll share the screen and we can start build. And then, the important metrics are pretty much by unit. So a lot of these, don't have the full info, but the economics and kind of the deal profiles kind of are evident through the per unit counts, and then we're comparing kind of where we stand relative to the market by looking at sort of the guide price that the broker put out or where the process is targeting versus what we feel we're able to pay, what we think makes sense in light of market conditions and the specifics of the deal. So obviously we're tracking, it's the product is, pretty typical for us, 1980s, value add through some newer stuff and a little bit older stuff, but that's the average. Anyway, so yeah, continuing on. So, and then pricing per foot, guidance in dollars. And then we like to keep track of cap rates and such, where the helps us keep track of where the market is, both what we're projecting and what they seem to be asking for, and the amount of lift overall as a measure of spread between the stabilized on cost and the going cap rate. And likewise, we track returns that we're targeting. So this is this column here would be the projected price. And then kind of what we're targeting, of course, what we're targeting is always going to be a lot higher. How far off or how close we are on the price, to keep track of kind of competitiveness. It's sort of both a reflection of, are we getting there, but also is the market priced kind of in a way that makes sense for us? And then this NOI, this is used to calculate cap rates. So these cap rates are not just like plugged in kind of from our calculation, they're actually done on the sheet. Using the actual NOI and the actual purchase price, both at the guidance and our price. And then likewise, you can kind of see CapEx per unit here as well for each deal. So that kind of gives us a sense of, for comparing the different deals, that's a key element that tells us, like, is this deal a heavy lift? Should we be expecting more returns? Or is this more of a kind of a straight down the fairway, easy peasy deal? Or maybe there's just not that much value add on top of it that can be done. And so then the CapEx will be lower. So that's kind of the latest thing is we're tracking.
And then just
to go to the summary stats.
Really quickly, to take a step back, also for those people that are seeing this for the first time, every row here represents a deal that we've underwritten through our full underwriting process and most likely have submitted an offer on. So where these numbers are coming from, as Charles mentioned, as far as the cap rates, the NOIs, the CapEx budgets, that's all happening in a separate Excel document, which is our underwriting model. So yes, so that's where the data is sourced for all these deals. And also, to take another step back as far as just general pipeline and deal flow, I don't know how many deals we have here, but we target to underwrite, I would say, and we could always do more, but I would say we're targeting to underwrite around 100 to really 100 to 200 deals a quarter. And so this isn't all the deals that we've underwritten for the previous quarter, but it is a good sample size. And as you see in the column H, most of these deals are on market. Some of these deals are off market. We'll talk more about that as that's a popular topic as well. But yeah, so that's just taking a step back. That's our pipeline, focus pipeline. So as you can see, most of the deals are in Houston. We're starting to underwrite more and more deals in DFW. So we started doing that a couple quarters ago. So we now have a few quarters of DFW data. So one of the interesting things that we might touch on today is talking about the way the data looks differently in DFW versus Houston, because there is a difference. So anyway, I just wanted to add those few things. But Charles, you can keep going.
Sure. So I guess just to kind of get us to the overall kind of picture, similar, I'd say, to last quarter, and we haven't got that in front of us, but I've got it here. And so we underwrote about $2 billion of deals in asking price, 14,000 units, at least in this sheet. These are the most sort of well fleshed out underwrites, oftentimes been through multiple rounds of bidding even. 1982 average, last quarter we were at 1981, average of 844 square feet. Last quarter we were at 832 square feet. So really very close. Deal size, I think so. Actually, if you see here, last quarter we were kind of 52.48 off market, and this quarter we're 53.47 off market. So we're kind of still maintaining a significant focus on, obviously there are more market deals than off market deals, but I think we kind of tend to select a little bit more, especially to get this far down the road on like off market deals that we feel we might have a special, like more likely to be a kind of an exploited value or a more differential value there. Yep. So, and then also interesting, I suppose, is that pricing. So pricing last quarter was kind of 140 average, and we actually saw it continue to go up, I think, to 142. I mean, it's pretty similar, but the pricing that we are willing to pay has kind of stayed. It's really stayed pretty steady, actually. Deal sizes were actually slightly smaller this quarter, although it's kind of skewed by the top end. So we're averaging 47 million, which is probably above the median, but that's a good chunk of change there. And last quarter we were averaging 59 million, which I think was pulled up by a couple of big things, and also by like a serious weird off-market deals that thought might make some sense. Let's see here, what else? Cap rates. It's always tough because you're looking at the cap rates in the market, and it's 3.2 to going in cap rate typically. And even if we're looking to buy it, it was at 3.6. Now, I think starting in the kind of, so this is actually in chronological order in terms of deals. So you can kind of see that this is kind of heat maps a little bit. And it's a slight trend, but it's visible. I think that, at the beginning, you got a lot of threes here in the top half of the sheet. And you start to see some fours creeping in, some higher threes towards this bottom half here as we get into the more recent months where we're seeing some rates moving and deals kind of experiencing difficulties, and of course it's been hard to buy them. think most notable actually about returns is that uh, we've seen. So I think with the and now we're seeing that we think it's actually 13.1. So that's 1.2% less in terms of what we think you're going to get going in. And then also we're also 24.8%, and this is on average, project IRR that we're underwriting, which is a full point higher than last quarter at 23.9. So that's this number here. So, you're starting to see that impact where, because the rates have been moving up, that we need to get a higher return to make everything work. The other part of this is that with the way that debt's been changing, we're not actually constrained by the the sort of the buy sell, which is, the cap rate on exit is what determines a lot of your IRR. And cap rates maybe haven't moved that much, but cash yield absolutely has moved. And so we're having to get high, like we're showing higher IRRs based because we're selling for lower prices. And why are we selling for lower prices? We're selling for lower prices because the cash flow is lower, and we just need to be lower to have acceptable cash flow.
Yeah, this is a really, really important point. And it's why you can't just look at a deal from one metric. You can't just look at cash on cash. You can't just look at IRR or price per door or cap rate or price per foot. So looking at, as far as return metrics go, we have those two constraints or targets, which are IRR and cash on cash. And as Charles mentioned, we generally can't do a deal if the IRR looks good, but the cash on cash looks bad, and or vice versa. The exception would be something, for example, like a heavy turnaround deal that offers no cash flow for the first year or so, but in the end, you get a big IRR because you turned it around. But even with a deal like that, your stabilized cash on cash is still strong, most likely. So the reason for those two targets and why both have to be met is it's really kind of a protection. It's almost like a protection against your making a mistake, because it's very easy to show a high IRR. You just lower the exit cap and just project to sell the property in the future for a higher price. And cash on cash is much harder to manipulate, and it kind of brings you back to reality. So even if you show a deal with a high flying IRR, it's going to get chopped down if it doesn't meet the cash on cash requirement. So it keeps you disciplined, and I think allows us to keep ourselves safe and know that we're not overpaying, because at the end of the day, you have to live by your cash flow and be comfortable with your cash flow. And if you end up holding the deal longer than you originally anticipated.
So kind of in that vein as well, the last quarter we had an average underwriting cap rate. So these numbers here are 3.6 and 6.1. So, we've seen the last quarter, we were actually making our deals work at 5.8% stabilized yield on cost. And now we're having to break 6 just to make anything make sense. And of course, if you look at the most recent, say like the last, what is this? 30 deals, it's close, it's above, it's 6.3, and if we look at only the ones in Houston, we're starting to really be a lot higher, so let's see here, 6.3. The most recent ones especially are coming in higher, the movement, where we were up here at the top, we were a lot of 5.7, 5.2, everything's in the fives. Now they're actually a lot more 6s just all over the place. So, we're having to take that into account. So we've been up 40 bips in terms of 30 bips in terms of what we were solving for in our stabilized yield and cost, which is kind of tracks almost exactly what you'd expect, given the interest rate rises, and also that's just an average. It's increased, in the more recent underwrites. Likewise, actually, we've also seen, in this environment, it's with construction costs, that there's obviously inflation, so things are costing more. Also, in this environment, like the market bailing you out, we have to make sure that we're, fully capitalized, and having a plan that involves actually doing something. And so last quarter, our average CapEx budget was 8705 a door. So this number was 8705 a door. And this quarter we're at 10,049. So it's, really just, we've seen increases in costs, and I'm being sure to take those into account.
So Charles said something that he says a lot, actually, and I want to unpack it a little bit. It's about how he said we have to actually do something to make the deal work, and that's really speaking about the low cap rates in the market, where it forces you to have a value add plan. You have to find ways to push other income and create value to get yourself out from under that low going in cap rate to an attractive yield on cost. And that has been true, and it's probably only gotten truer as debt has become less accretive. The counter to that is, well, can you buy, just instead of a value add deal, can you buy a stabilized deal, maybe a newer product in a nicer core location, and you're going to accept a lower IRR, but maybe you can manufacture some decent cash on cash, and you're taking less risk because you don't have business plan implementation risk, and you're just you have a higher quality asset. So that, I think, is one valid way to go. But then the problem is, how do you finance it? I think that is the really big challenge with the market right now. And Charles is talking to lenders and debt brokers every day, so we have the inside track as far as what's going on in the debt market. And from what we understand and what we're hearing from bridge lenders, and there's two problems, and this is somewhat of a bigger tangent, but there's two problems, right? On the bridge side, we're hearing more and more that lenders want you to actually do something. They are not just happy just to give you a bridge if the deal isn't really well suited for a bridge. Rewind 6 months ago, bridge lenders were putting out money at rock bottom pricing, and they didn't really care if your deal actually penciled. They're just putting out money. Now they are really actually seeing, well, do you actually have a business plan here that's actually going to create value for this deal, and to make the bridge loan make sense. So that's one problem, right? You can't buy a new shiny deal with a bridge loan. And then on the flip side, how do you use permanent financing for a stabilized deal, because the going in yield doesn't cover, which means that because permanent financing is sized based on in-place income, you can't really get any leverage. So I'm seeing people do deals at 50% LTV, which is very different than the 75% LTVs that they were doing 6 months ago. So anyway, that's kind of, I think, one of the biggest challenges in the market. Charles, do you have any thoughts there?
Yeah, I mean, I think we saw that it's hit, especially deals that had weak going in cap rates. And, there's been two kind of, things that happened with the bridges, and, at least some of the two things. There are probably more things, but, one is that just anything with weak going in cover, and a low cap rate got hit disproportionately, right? People kind of are happy to finance something with a 4 on it, but stuff with a 3 just not so happy anymore at all. Even if it's a newer, nicer asset, and maybe there's a reason for that, it's just at the end of the day, the numbers need to be there, and they're not there if it's that profile. The other thing is that, like Rob was saying, you have to actually do the work and do something. And so people be buying with bridge, and they'll be buying a deal, and it's they want to actually, because basically what everyone was doing was they would be buying with a bridge loan, max leverage, and then you would figure that just the inflation and rents would basically cover what you need to kind of make the deal work, and that was what everyone was underwriting. But now that kind of level no longer flies, and the kind of light value add, or sort of like we're doing a light value add, but really we're achieving our value add just using market rents, that's no longer acceptable. You have to actually be justifying your rents with what you're doing, and it has to be above inflation. So, so yeah, on that point about having to do something. So I guess also you can kind of see there's been, some logical order. At the beginning here, we've got like the first, say, 12 deals or so, average of 3.2% cap at the broker ask, and we wanted to buy at 3.6%. And then for the last 3% that they want, and we're at 4.1. So, with the change, so we've been up 50 bips, and the going in caps at the ask kind of we're hovering, but not as much. And, with the pricing today also is that, there are a lot of these processes at this point that haven't really succeeded, and some of these or that have seen significant markdowns. So it's kind of tough to see in this analysis, just because actually tracking, or we're looking more where we want it. But deals in the last 2 months that have been out are just either choosing to hold, or the pricing's down 15% or more, 25% even in some cases.
Yeah, and this is also very early, right? This data is from Q2, so there's already been, we're in July now, and there's already been changes since June that we're seeing in the market, and I think there's going to be more movement in this direction.
I think there's a lot of it is that initial shock, with the.
The other comment, I've been saying this a lot, but I'll say it here as well, is the way that we've changed our debt strategy. So at a high level, obviously debt has gotten a whole lot less accretive. So logically speaking, if something is less accretive, it would make sense to use less of it. And the other thing is there's higher risk in today's market than before. So that's also another strong argument to use less leverage. So that's kind of the high level why you would want to, but then you just look at the practicality of it as well, and you can see that the 80% debt is not available anymore. It's very expensive.
Yeah, and so again, you can see that that's weighed on prices so we track, our kind of bid to what the guidance is, and last quarter we were around 92%, a time high 80s, mid, percentage of, so we're significantly wider than we were before.
Yeah, and the price difference between, real quick, the price difference between 65% and 80% is huge now, whereas 6 months ago it was nominal. There was a very small difference. So that is also a factor in terms of your decision regarding taking on incremental leverage.
Well, right, and like in practice, of course, that just means people, the deals, the cap rate's the cap rate, and the yield and cost kind of is, it does depend on what you think is achievable in the market. So like if your debt just exceeds the yield on thing, then it's not going to leverage, or 10% of leverage exceed is going to cost you like a point or something, then it's going to kill the deal. And so that's obviously been what is, causing these changes. But it also creates opportunities, so like with this, some sponsors I think were kind of more ahead of it than others, and of course there was kind of this rush, I think, to some extent. Like you could see there was a huge surge of deal flow in the first maybe quarter and a bit. As kind of everyone figured that this was going to happen to a more or less extent, with the rates moving, and so a lot of people were trying to sell then. And then so maybe there's kind of this push to get someone under contract to buy the thing at that price before kind of the cliff hits. And so some people, kind of on the margin got in over their skis. So you're seeing these opportunities arise where, maybe a deal fell out, and that there's quite a bit of that, going back to the kind of the second bidder or third bidder or whatever. Which also means you have to be careful because, even if you're like the fifth bidder because you could be called on it. So it's but it's definitely a source of opportunity. So with an 87%, bid to ask, I guess, that we're at today, that's also been a movement, not just on our part, but in the market, that is creating some opportunities.
Do you want to do a DFW versus Houston discussion, or do we want to talk more about pricing trends just broadly?
I think, we can have a kind of a discussion. I mean, it's kind of the same story as you expect, really, I think, which is, price per door is higher there. We're looking at 162 average guidance. Sorry, 1 second.
Yeah, so while Charles is working on that, as far as the typical story that we've been seeing as far as DFW Houston for years is just that DFW is just a bit more pricey on a price per door basis because rents are a bit higher and cap rates are a decent bit lower. And that the reason for that is because investors generally are more optimistic about DFW. They think the growth is better, jobs are better, it's a more resilient market. So that's why it trades at a premium to Houston. With that being said, I felt and still do feel that DFW prices will come down more than Houston prices, which we are really hoping will present a buying opportunity for us in DFW because we've never been really able to make the numbers work. But that's just my suspicion, and I think Charles agrees.
Yeah, so I mean, you can see here with, average vintage in dollars that we've been looking at is 1977. The price per door is higher, so 162. So they're older and the prices are higher. Cap rates have been tough, 3.2 average, but you see some twos here, a good number of twos. And so and we're having to, as a result, we're having to solve, a lot of sick costs. So the bottom line is, so we've been more consistently looking at older product in Dallas as well. So like this 77 or whatever. Our average age in Houston is 1984. And we have a number of, 2000s builds in there. And so, that really speaks to the fact that on average, the pricing per unit is higher. And yeah, it's just, the thing is, I will say, on the returns front, I think, we're also, we are reflecting those increased growth prospects. There's some outliers. I think we're definitely anticipating some growth in Dallas. So you can see that our average bid ask there actually is about the same, 88% on average, as across kind of both markets. But it's absolutely tough, and but probably it is. I will say in Dallas, it has probably been hit harder because the growth is such an aspect, migration is such an aspect. Through the recession, that would be hit. And just a lot of deals. I was there 2 weeks ago, and a lot of the brokers are kind of like, well, I'm on vacation, haven't got anything right now. There's like this stuff if you want that's available that hasn't traded from 2 weeks ago or whatever, but you have to pay yesterday's price probably still, and a lot of it, and it's starting to move. But of course, the buyer pool is shrunk significantly as well. So it's just the prices moved down this much, and like what people we can pay has gone down more a lot of the time. So, and especially true in Dallas, definitely.
What I think is really interesting, I was very surprised at how quickly the market adjusted to that initial price move, right? Everyone was saying, oh, prices are down 10%. And everyone handled it very well. Sellers handled it very well. And transaction volume remained high, at least in our market, at least in Texas. However, DFW is one of the high growth markets, like Charles said, in the country. You've got Denver, DFW, Tampa, all of Florida, Phoenix. And so I'm also hearing in Phoenix, though, that transactions have really slowed down, and which is maybe somewhat surprising to me, because I would think that because it's performed so well, sellers are sitting on so much capital gain. You would think they'd be willing to lower their price and still move and take their win. But it seems like it's the opposite. It seems like, if I'm not mistaken, DFW has slowed down transaction-wise more than Houston. And from what I'm hearing, Phoenix is very slow. So maybe it's the high growth markets that are slowing, because that's where sellers or owners have the highest expectations for their sale value. And, they're just shocked by what the brokers are telling them. So they're just, no, I won't sell then.
Well, a lot of it also is that in those markets they have
normal time.
In Dallas, there's been some activity recently. It's been on fire, right? So, like, of course, first of all, there was further to fall, and second of all, a lot of these deals actually are, 2 years maybe in hold period, or even less sometimes. I think there's a lot more of that just rapid flipping, and so to some extent, the buyers actually, they they didn't experience the growth because they just bought it. Some of them, or the sellers even. I think that my perception is a good amount of that in Dallas, and that's also probably part of that phenomenon.
But
there's just been further.
That doesn't really explain why Houston seems to be chugging along still.
Well, because Houston never attracted the same kind of because a lot of people were just like, no, Houston, but people could kind of sell themselves in the Dallas growth. I think Houston, so Houston never really got as heated. It was just starting to get heated maybe, this year.
Yeah, you could make the argument that markets like Phoenix and Dallas were decoupled or getting decoupled. The valuations were getting decoupled from fundamentals, but I would argue most likely not, because lenders have done an excellent job keeping everybody in check for the most part this cycle. But yeah, it's a fair point about Houston. The numbers have always just made more sense in Houston, right? We joke, but it's not really a joke, that you buy Houston based on the numbers, and you buy Dallas based on the story. Real quick,
so
Charles.
with Dallas,
I'll take this question here.
Yeah.
I'm going to take this question here from Joshua in the chat. And if people have questions, please just put them in the chat, and then we'll probably wrap up here soon, and we can just have regular Q&A if you want to unmute and have a conversation. But Josh was asking about perm financing and its restrictions based on in-place income. What alternatives are we reviewing to achieve our debt? Or are you just okay with taking lower leverage options? So yeah, we have shifted our debt strategy, going from 80% leverage, 75% leverage down to 60, 65. So that's kind of a nice, easy move. It's not easy for us. We have to raise almost double the amount of equity. So it's a lot more work and it's less profitable for the sponsor to do that. But it just seems like really the best option for us by far moving forward to just trying to get deals done, put together the best deals for our investors, and protect ourselves on the downside. So that is number one. And that lower leverage debt is still bridge debt. So it's not perm debt. So that doesn't quite answer Joshua's question as far as the restrictions on perm financing. Sure, we would love to do perm debt. It was hard before all this stuff. Last year, we were really fortunate to do 2 deals on perm financing because they had cap rates that could support the in-place income underwriting. But by and large, very, very few deals can do that. And that goes back the last few years at the leverage points that we were looking for, around 75. So the lower leverage stuff that we're doing today is still bridge, but now it's bank debt, and it's still 3+1+1 term structure. So 3-year initial term with 2 1-year extension options. So I think we haven't gotten too creative, but that is what we've done so far.
Yeah, I mean, I'm not sure what alternatives there would be because of some extent, which is why the deal now actually than it was, just because it's a bit less competitive and the pricing has moved. But there is less volume slightly at the moment. So